So welcome all for today's session, Advanced Financial Reporting. And today we'll be covering a topic called Group Cash Flows or Accounting for Cash Flows. And cash flow is regulated by IAS number 7. And what's a cash flow? Now a cash flow is just a statement. It's one of the among the published financial statements. In this case shows the actual cash inflow, the actual cash outflow. It shows the liquidity position of the company. It shows how the money was coming in and how the money was going out. Then the format which is provided by IAS number 7 usually does not change. And it provides this format. Under this format, cash flow items are classified into 3. We have 3 activities which affect the cash flows. 1, we have operating activities cash flow. We have number 2, investing activities cash flow. And number 3, we have financing activities cash flow. So those are the 3 major activities under the statement of cash flow. So we start with the first one, the operating activity cash flows. Now operating, they are day-to-day activities. That's day-to-day. Then for the investing, it deals on how the company acquires and disposes assets. That's all about the investing. And then number 3, when you have the financing, for the financing, it deals with how do we finance the business. When you talk about the financing, we may finance the business through the issue of share, the issue of debenture, the issue of bond, we can borrow, loan repayment, leases. That's what affect the financing activities cash flow. So, and when presenting the statement of cash flow, we have 2 formats which are created by IAS number 7. One, we have the popular method, which is the indirect method, and then we have the direct method. So I want us to go through that format together. So, and I want us to start with an indirect method of presentation of cash flow. And the indirect method, how do we present? Under that statement, we start with the operating activities cash flows. And under operating activities cash flows, we always start with the profit before tax, bring your profit before tax, and then adjustment. Now, under the adjustment, what we usually do, we add back the non-cash expenses, which had already been deducted, and also we add back non-operating expenses, and then we deduct non-operating incomes. So we take profit before tax, and adjustment, you add back depreciation, impairment, and amortization because they are non-cash expenses. We have said that under statement of cash flow, it deals with actual cash inflow, actual cash outflow, no provisions. Then loss on disposal, you add back because loss on disposal of an asset is not an operating activity. And then finance cost, you add back. We are adding back the finance cost. That's the interest. Finance cost is the same as the interest. You are adding it back because finance cost is not part of the operating activity. Finance cost is part of the financing activities. And then gain on disposal, you deduct it because it's an operating income. Then associate profit, you deduct, it's an operating income. Then investment income or dividend income, you deduct it because it's an operating income. It's part of the investing activities cash flows. And then from there, we bring the working capital changes. And the working capital changes, we're considering 3 items, major 3 items. Changes in inventory, receivables, and payables. Or in short, current assets. Current assets except cash and current liabilities. So that's what aggregate for the working capital. It's the current asset and the current liability, but in this case, excluding the cash or the bank account. And then from there, we may have the gross operating cash flows. Then you have the gross operating cash flows. Then you deduct the tax paid for you to get the net operating cash flows, which is denoted by, I can denote it by A. Now, the other part we have is the investing activities cash flow. We have said that under investing activities cash flow, it deals on how do we acquire and how do we dispose the asset. So, you bring the cash proceed on disposal of asset. In case you dispose an asset, the actual amount to receive, you add it there. Then dividend received, and mostly receive the dividend from the investment, mostly from the investment in associate. And then investment income, you add it. Then still under that, dispose of subsidiary net of cash disposed. So in this case, mostly we'll be focusing on cash flow for groups. So in this case, when we are accounting for groups, in case there was a disposal of subsidiary, net of cash disposed, that is very key. So I'll come to explain what does that mean. And also, Acquisition of subsidiary, net of cash acquired. That one is an outflow when you acquire another subsidiary. And also acquisition of non-current asset. If you acquire non-current asset, that one is a cash outflow. So the good thing you need to note that under statement of cash flow, it's not about writing the amount. It's all about determining, is it an inflow, is it an outflow? Then we have the financing activities cash flow. This is the last part. So for the financing activities cash flow, we say that it deals on how do company finance their business. Is it through the issue of share, issue of debenture, loan, leases, etc. So we have, you start with cash received from the issue of share, you add it. Then cash received from the issue of debentures, loan borrowed, but in case there was loan paid or loan repayment, that one is an outflow. Then we have dividend paid. Remember, you can pay dividend number one to the ordinary shareholders or to the non-controlling interest. Then we have the interest paid or the finance cost, you deduct it. And then lease rental paid, you deduct it. And then you can be able to get your net financing cash flows. Then after you're through with all the three activities, now you determine cash and cash equivalent by taking A plus B plus C. A was the net operating activities cash flow. B was the net investing activities cash flow. And C is our net financing cash flow. You add it there. You add all the three. And then you add cash balance brought down. If you take the cash and cash equivalent, you add cash balance brought down, it should give you the cash balance carried down. And this one should balance with the amount of the cash in hand at the end of that period. Now that's what we call the indirect method of cash flow presentation. Then, what about the direct method? So this is the format for the direct method. So the difference between the indirect and direct method, it's only that the only part which changes is only the operating activities cash flow. So for direct method, operating activities cash flow will be reduced to this. So you'll be starting with the cash received, you raise cash paid. It's only cash received, cash paid, and then you get the gross operating cash flows. To get the gross operating cash flows, you raise the tax paid, and that's how you get net operating cash flows. So when presenting the direct, so that one will be A. Now, the other parts, that's for the investing activities and the financing activity, does not change. It's the same thing. So the only part which is changing is the operating activities cash flow will be reduced to that. I want you to compare that. You compare that against this. So under indirect method, that's the operating activities cash flows. So, but when presenting using the direct method, it will be reduced to that. Good. So now with that, so let me give you a secret. Cash flow never misses in each and every exam. And cash flow, if you want to pass the cash flow, it's all about determining the format. Make this format to be at your fingertips. Both the investing activities, financing activity, and the operating activity. If this format stick to you, so when interpreting or when doing the workings, it's not that a nightmare. So the big problem for the student need to note is just getting the format. If you get the format correct, you are good. So now with that, I want us to do an illustration from the past paper. And we start with May 2014 question 3. May 2014 question 3. So let me read the question. Hoping you have the past paper with you. And we are told that the following are the group income statement and group statement of financial position of Soma Group of Companies for the financial year ended that 1st October 2013. So we have the income statement where you have the revenue, cost of sales, we have the gross profit, other incomes, expenses, profit before tax, tax expense, profit for the year, and then we have profit attributable to the holding company and then to the non-controlling interest. Then we have the statement of financial position. Now, for the statement of financial position, you'll always be given for 2 years. That's the current year and the previous year. So, for example, let's go to the statement of financial position. If you start with the non-current assets, we have the plant, property, and equipment, or property, plant, and equipment. So, you have 2013 and you have 2012. For example, PPE for 2012, the amount was 1525. But as 2013, it's 1900. You see there is a change. So now that change, that increase or decrease, you have to explain it through statement of cash flow. So why did it increase? So in that case, you have to determine why did this cash flow changed. So in that case, you will explain that through the statement of cash flow. Good. So that means to the statement of financial position, all the item under that you have to open an account. You have to explain everything. Except, so those are the items you are not supposed to adjust. I'll show you how to adjust them later. Current assets. For the current assets, remember inventory, receivable, short-term investments, and then under the current liability, let's go to the current liability. Trade payable will give you the working capital changes. Sorry, let me repeat again. To the current assets, inventory, receivable, and to the current liability, you have trade payable. Those three items will give you the changes in working capital. Then short-term investment under current asset, cash in hand, and then let's go to the current liability. We have bank overdraft. That will give you cash and cash equivalents. Good. That means all the other items, apart from the current assets, and the under current liability, the trade payable and bank overdraft, all the other items you have to open an account to explain why they changed. Good. Let's go to the additional information. Number one, you are told that during the year ended that 1st October 2013, Soma Limited acquired 80% of the share capital of Kitabu Limited. So that means we are dealing with a case of acquisition. So this is a case of acquisition. The asset of Kitabu Limited was follows at the date of acquisition. So they had PPE, inventory, receivables, long-term loan, payables, bank balance, and taxation. And the net asset acquired was 250. Number two, some item of plant with an original cost of 425 million and a net book value of 225 million were sold for 160 million during the year ended that 1st October 2013. The long-term investment was sold for 150 during the same period. And then the following information related to property, plant, and equipment. So you have for that 1st October 2012 and 2013, the cost and depreciation. So whenever you are given the PPE, the breakdown for both the cost and accumulated depreciation, when opening a T account, for the PPE, you have to open it at cost and then accumulated depreciation. You don't have to open at net book value. So let me repeat that again. I'm saying that for the PPE, if you're given an additional information, if you're given both cost and accumulated depreciation separately, when opening the T account, open two different accounts. That is PPE at cost and then accumulated depreciation account. But assuming you are not given this information, the cost and the accumulated depreciation, you open one account at net book value. Good. The cost of plant of Kitabu Limited, the acquired subsidiary, on the date of acquisition was 500 million and accumulated depreciation of shillings 200 million. And during the year ended that 1st October 2013, there was a revaluation gain of shillings 50 million attributable to the holding company's plant. And lastly, number three, the total purchase price of Kitabu Limited was 225 million, paid by issuing shillings 50 million worth of ordinary share at par value. The balance was paid in cash. Good. Required. Group statement of cash flow in conformity with IAS 7 statement of cash flows for the year ended that 1st October 2013 using the indirect method. So they have specified you need to use the indirect method. So now with that, we'll have to open some accounts. And when opening those accounts, the T account, it's all about we need to adjust. So